Hello and welcome back to my Dinar Daily YouTube channel. The intersection of geopolitical shock, institutional reform, and retail investor psychology currently playing out around the Iraqi dinar represents one of the most complex and layered financial narratives in contemporary emerging market history. At its center is a fundamental tension. The structural case for Iraqi monetary reform has never been stronger, yet the noise surrounding it, from breathless military source rumors to gold-backed currency notifications, allegedly loaded for Sunday night, threatens to obscure the genuine signal beneath an avalanche of speculative chatter. Serious analysts of this situation must learn to hold both realities simultaneously, that the macroeconomic and geopolitical architecture supporting a dinar revaluation is real, substantive, and advancing on multiple institutional fronts, and that the timeline predictions, insider notification claims, and imminent exchange narratives circulating in retail investment communities have a long and consistent history of being wrong. The challenge is not whether Iraq's monetary reform is coming. The challenge is maintaining analytical discipline in an environment saturated with noise, so that when the genuine inflection point arrives, investors are positioned on the basis of substance rather than rumor. Begin with the most concrete and consequential development, the Strait of Hormuz closure and its acknowledged impact on Iraqi fiscal planning. The confirmation by Prime Minister's financial advisor, Mazar Mohammad Salih, that the government will resort to domestic borrowing if the Hormuz closure persists, with material fiscal impact expected within 2 to 3 months, is a significant admission. It reveals both the vulnerability and the resilience of Iraq's financial architecture. The vulnerability is obvious. Iraq's export revenues are heavily hydrocarbon dependent, and any sustained disruption to Gulf shipping lanes compresses the revenue stream that funds government operations, reserve accumulation, and the structural reforms that underpin the dinar's eventual revaluation. The 2-month lag before impact materializes reflects the buffering capacity of existing reserves and pre-committed sales contracts, but it is a countdown, not a reprieve. Critically, however, the countervailing headline that the Central Bank of Iraq is capable of providing full financing for an entire year, even under Hormuz closure conditions, reframes this vulnerability as a managed stress test rather than an existential crisis. If accurate, this reserve adequacy means Iraq can absorb a prolonged disruption without abandoning its monetary reform trajectory, its IMF compliance commitments, or its exchange rate management framework. That is not a small thing. It means the institutional architecture built under al-Sudani and Iraq is more robust than Iran or any regional spoiler may have anticipated. The U.S. State Department's weekend demand that Baghdad take urgent action to dismantle Iranian-backed militias described as necessary to stop ongoing attacks against both international and local interests, including the Kurdistan region, adds a sharply political dimension to this fiscal picture. Washington's framing of this as an urgent and once and for all imperative signals that American patience with Iraqi ambiguity on the Iran file is running thin, and that the deeper U.S.-Iraq economic partnership, including the investment climate reforms, currency normalization, and bilateral trade architecture that dinar revaluation would facilitate, is explicitly conditioned on Baghdad's willingness to assert sovereign control over its own security environment. This is Trump's transactional logic made concrete. The United States is prepared to be Iraq's most powerful economic partner, to welcome American companies into Iraq's reconstruction economy at scale, and to provide the diplomatic and financial backing that gives the dinar's revaluation global credibility, but not while Iranian proxy militias operate freely within Iraqi territory and attack American interests. The militia dismantlement demand is therefore not merely a security request. It is a prerequisite condition embedded within a much larger economic negotiation, and Baghdad knows it. This dynamic also explains the political paralysis surrounding government formation. Parliament's decision not to hold sessions while the Iran conflict is active, Kurdistan's deliberate hold on announcing its presidential candidate, and the absence of any formal rush to officially nominate al-Sudani as prime minister all reflect a sophisticated political calculation. No Iraqi political actor of consequence wants to take ownership of major structural decisions, including exchange rate adjustments, while the security environment remains unsettled and the relationship with Washington remains in active negotiation. This is not dysfunction, it is sequencing. The legal capacity for the central bank and its institutional gatekeepers to adjust the exchange rate already exists under current government authority. Sudani and Rashid are in place. The IMF, World Bank, and EBRD have already signaled their expectations, transparency, rules-based governance, and the kind of institutional credibility that Iraq has been methodically building. The rate change, when it comes, does not require new government formation as a trigger. It requires the right geopolitical moment, and that moment is being shaped by events in the Strait of Hormuz, in Washington's militia ultimatums, and in the quiet institutional preparations that central banks make before they act. The comparison to the 2008 financial crisis carries more analytical weight than it might initially appear. The central insight of that episode, that a small group of investors with a coherent thesis, strong conviction, and the discipline to hold their position against overwhelming institutional consensus were ultimately proven correct, is a legitimate psychological framework for long-term contrarian investment. Alan Greenspan's famous confidence in housing market stability, echoed by regulators, bank CEOs, and mainstream economists, was not stupidity. It was institutional groupthink reinforced by incentive structures that punished dissent and rewarded conformity. The Dinar investment community's self-identification with the Michael Burry archetype, the lone analyst who sees what the crowd cannot, is emotionally compelling and not entirely without merit. Iraq's macroeconomic reform story is genuinely underreported in mainstream financial media. The institutional depth of its central bank reserves, the seriousness of its IMF engagement, the significance of its ISO 2022 digital currency architecture, and the geopolitical weight of U.S. engagement with its monetary system are all real developments that most retail investors, let alone mainstream financial commentators, are not tracking with any rigor. In that specific sense, the Dinar investment community has done analytical work that deserves respect. Where the analogy breaks down, and breaks down decisively, is in the domain of timeline claims and sourcing. The 2008 short sellers had documentary evidence, mortgage data, default rates, tranching, structures, and auditable financial instruments. They had verifiable theses. The weekend claims circulating in Dinar communities, high military sources confirming gold-backed currency notifications, loaded for Sunday night, exchange notifications to be released Monday or Tuesday, imminent tradable asset-backed currency events, have no verifiable evidentiary basis whatsoever. These claims have appeared, in various formulations, for well over a decade. They follow a recognizable pattern: high authority source, compressed timeline, imminent action, followed by silence and reset. The investors reportedly turning down cash offers of $1 per dinar, believing they will receive exponentially more within 2 to 3 weeks, are making the high-stakes financial decision on the basis of social proof and community confidence rather than verifiable institutional data. That distinction matters enormously. Conviction built on real macroeconomic analysis is an asset. Conviction built on unverifiable insider claims, is a liability dressed as confidence. The genuine investment thesis, the one grounded in something real, runs as follows. Iraq is a resource-rich nation with a deliberately suppressed exchange rate, advancing toward ISO-compliant digital currency infrastructure, under active IMF and World Bank engagement, with a government that has the legal authority and institutional capacity to adjust its exchange rate, backed by a U.S. administration that has made Middle East economic reintegration a strategic priority, operating in a geopolitical environment where Iranian influence is being actively confronted and where Syrian banking reintegration is simultaneously advancing. That is a real thesis. It does not need military source notifications to be compelling. It needs patience, risk management, and the analytical discipline to distinguish between the structural story and the noise that surrounds it. Trump wanting to get paid, the shorthand for U.S. economic interests, driving Iraq's reconstruction and investment opening, is a real policy orientation. It does not, however, operate on the timeline of weekend predictions. It operates on the timeline of geopolitical negotiation, institutional compliance, and sovereign decision-making, all of which move on their own schedule and answer to no retail investor's urgency. What this moment calls for, above all, is the same quality that distinguished the successful 2008 contrarians from those who merely had opinions: disciplined patience grounded in verifiable evidence. The structural case for Iraqi monetary reform is as strong as it has ever been. The geopolitical conditions for a managed readjustment are actively forming. The institutional gatekeepers are watching. The compliance frameworks are being built, and the diplomatic architecture is being assembled. All of that is real. The question is not whether, it is when, and when is not determined by anonymous military sources or Sunday night notifications. It is determined by the convergence of institutional readiness, geopolitical stability, and sovereign political will. That convergence may be closer than mainstream consensus acknowledges, but it will arrive on its own terms, not on a rumor's schedule.